Okay, guys, so this is the 8th of our YouTube mentorship for the month of June 2024. We have actually talked about a lot of things, right? I've talked about a lot of things. We started with market structure. We talked about risk management. We also talked about the daily range. Some people call it CRT, that's the candle range theory. Some people call it turtle soup, so and all of that, right? So now we are still on the topic of market structure, right? But these are the more intricate details, right? So if I would like to know where you guys are watching from, right? You know, YouTube tells me that Nigeria holds the number one of my um views. Like most of the people watching these videos are from Nigeria, right? But I also notice that I can see South Africa, I can see India, right? So if you are watching this video, please do want to drop the country that you're watching from so I can know for a fact where you guys are watching from. Are you watching from Nigeria? Just write Nigeria. If you're watching from Cameroon, Ghana, India, China, wherever you are, please just type it so I can know where these videos have gone, how far these videos have gone, right? So today's teaching would not be so long, but it will be very full of value, right? So let's go to the topic of today. Please, if you, wherever you're watching from, just type your country that you're watching from. I'm not asking you to type your address, no. I didn't say you should drop your location, right? I didn't say your home address. I just say the country. If it's Nigeria, just type Nigeria because Nigeria is a very large area, right? So for security details, just type only the country you are coming, you're watching from, right? That is all. All right, so let's talk about the power of three, right? Now we are heading into time and price. Now, this is one of the biggest secrets of my trading, all right? And time and price is actually a very broad topic, right? It is one of the secrets of most traders, right? Although I might not go into too much details because this is really paid mentorship stuff, right? When you have a paid mentorship, obviously there are things that you leave out for them because those are the ones that are committed with their finance, right? It's not fair that the same thing you're teaching your paid students, you're also teaching the free YouTube, right? So there has to be something that you leave for the paid ones because those ones are committing their finances to you. So they're saying, okay, I want to pay you for your time. I want to pay you to learn, right? So there's no way you just carry the same thing that you're giving those who are paying you that are committed with their finances, right? And then you're giving it to the free YouTube the same thing. No, you have to, reserve something special for the ones that pay, right? So that is basically what I'll be doing as well, because that is what we call value for money, right? So I'll just be introducing power of three. I won't really be touching too much into time and price because this topic is something that is very unique for the paid students, right? It's very unique for paid students, this particular topic, right? So I'll just be touching a bit about it and then we'll see how far we can go, right? So even if you're watching this from the free YouTube, don't worry, you can still do much with this, right? You can still do much with this. Just that I will not be going into much details, especially when it comes to the lower time frame aspect of it, right? So that's what I'm reserving for my paid students, right? So now for the power of three is very, very simple. It's something that ICT taught, right? Now, I want to give credit to who credit is due. ICT taught this, right? I'm not the one that invented this. I did not found anything. I did not find anything, right? It was founded by ICT, and it's something I've been using for, I think, the past 2 years now. I've been using this simple concept, the power of three, right? So this is an ICT concept. I'm not the one that founded it. It's ICT that actually founded it, right? So the power of three refers to three things. So that three refers to what? A, right? A, M, D. So also when we see power of three, refer to three things: accumulation, call it the AMD. We're talking about the manipulation, and we're talking about the distribution. Don't worry, I will explain this. Don't worry, don't just worry about it. Distribution, manipulation. So you here, right? So these are the three things we are referring to, right? And when we are talking about the power of three, we are typically referring to the daily candle, right? So the daily candle is the subject of interest. So we use our daily candle as a subject of interest, right? the SOI, the subject of interest, right? So we're focused on the daily candle, right? So now I've taught you guys a bit about this yesterday when I talked about turtle soup. It's just that, but now you guys are going to get the better explanation of it. Now, in every daily candle, we notice that we have a body of the candle. We also have the wick of the candle, right? The upper wick and then the lower wick, all right? We have the upper wick and then we have the lower wick, right? I have the lower wick. Sorry, this is not. So we have the upper wick and the lower wick. Now, what the power of three, the theory that is propounded by the power of three is that whenever we have a bullish market, we see price run below the open price and then what? Running higher. That means when the market opens, we see the market open here, drop down a bit before running higher, up. So now we want to classify this movement, right? So the market opening here and running down is what we refer to as what? The accumulation and manipulation. So the market, first of all, accumulates short orders. So the market running down is the phase what we call the accumulation and the manipulation. Now the market intends to go upwards, but it first does what? Gives its manipulative leg. It tricks people that are chasing price into going short before the original direction is what? Being fulfilled. All right. So accumulation simply means that the market is accumulation. It want to accumulate or it's accumulating orders to go long. But first, it gives what this manipulative leg. Market first of all, it runs down before they was pushing higher, right? So now this run down is also referred as what the manipulation. Why the distribution is when the market does what it pushes up. So now when the market is up by the manipulation, it's not doing what begin to fire up. So this upward movement is also referred to as what the distribution. I mean, the market is doing what distributing the original orders, which is what the long orders, right? Do you understand that? So just notice whenever the market is bullish, it tends to give what a manipulative leg to the downside, right? Write that down. Write it in the comment section. When the market is bullish, it tends to give a bearish manipulation move, right? Just write it that when the market is bullish, it tends to first give a bearish manipulative move. And the market wants to go up, it first of all guess what? This bearish manipulative move before they what rally into the overall what direction. That's what this thing simply means. And then if we are talking about a bearish scenario, then the reverse becomes the case. That means when price wants to run down, it first of all does what? Give what? Its manipulative leg first to the upside, right? And then what happens next? Market does what? Shoots down. So now, this push up is what they refer to the manipulation. Market wants to go down. Well, first of all, pushes up before they was giving the overall move to the downside. So now, if you understand it, then you know that whenever you want to buy a market, you are expecting the market to do what? To drop down first, right? Whenever you want to buy a market or buy a particular currency pair, you want to see the market push to the downside first before you start looking for what? Your sells, right? Or your buys, right? So I'm trying to get some charts so I can understand this things. Now, this is a GBP/USD, right? You can see that this was an NFP. Can you see NFP? Let me take this off. So can you see NFP yesterday? What happened there? Can you see how the market wanted to go down? What happened first? First of all, it pushed up. This was Friday. This is Friday. Right? This is Friday. Friday opened somewhere around there. Okay. This was Friday opened. Can you notice that the market wanted to go down? What happened first? It pushed up, blew this liquidity here, took out this liquidity there, right? Took out this high as well. It took out this liquidity as well. And then what happened? Market was ran down. So you can see that whenever the market wants to go down, it first of all gives this a manipulative leg on the upside. So if you check it on the daily chart, you can see the same thing there. Can you see how the market pushed up before they were dropping down? That is what we call the power of three, right? Can you see that each time a bearish candle prints, it always gives that same move, right? Just observe the bearish candles here. Can you see the market pushed up first before dropping lower? Can you see this one as well? It pushed up before they were dropping lower. You can see this one as well. It's pushed up before dropping lower. Why the bullish ones will do the reverse? Can you see how the bullish candles push down first, taking out liquidity before they were pushing up? The same thing here. push down, push up, push down, push up. So this is what we're trying to say. Now, whenever you're bullish or bearish, you have to always consider what that manipulative leg, right? So you don't have to chase this move, because some people will see this bullish push and be like, oh, the market is buying. Maybe they will go to maybe 30-minute charts. Now they'll just rush the 30-minute charts. Oh, the market wants to buy. It's bullish. It's bullish. It's bullish. It's bullish. They'll be like, okay, the market has given a bullish block. Look at other block here. It's a bullish order block. The market bullish order block. And like, oh, the market is going to go up. Oh, you say, okay, look at this demand zone here. They'll be like, okay, demand zone. The demand zone. The market, look at this imbalance here. They will, market would have whipsawed them. Be like, okay, market is bullish. It created this imbalance. There's a bullish break of structure. You can look at this. Look at inducement here. The market wants to come down and tap my POI, and then you'll be like, oh, there was even a liquidity grab. Look at liquidity grab here. Like, oh my god, liquidity grab. Oh my god, it grabbed liquidity and it shot up. This is an A plus setup. A plus, A plus. And then what happens? The market does what? Gives them a B, right? So from A plus setup, the market gives them a B, right? So that is what I'm talking about. So the market always gives that power of three movements, right? So whenever you're bullish or whenever you have a bias in the market, always, although it is not all the time, right? So remember that there's a disclaimer for my videos. Everything I teach you is subject to what? Scrutiny. That means you can go through your chart and prove me wrong. If I'm wrong, then you prove me wrong. If I'm right, then you prove me right. Right? Remember, everything I say on this video, on this YouTube channel, is subject to what? Scrutiny. You are free to go through and check if it's true or not. Don't just take everything hook, line, and sinker. Right? Whenever anything is given to you on this channel, just go back to check and study it. I didn't say you should trade it. Study if it's true or not. Then you can make a decision from that. Right? And don't forget if you can remember this, where I gave you guys where EU will go. Don't forget yesterday's analysis. I told you guys that EU was going to go for this low. Can you see that? Remember, I told you guys that price ran this high and it was going to go for this low. Don't forget, go and check my YouTube video, the yesterday's one. Check the last, just check on the 20th minute. Right, so check on the 20th minute of yesterday's video. You see where I called the market live. The market was all the way up here. I told you guys the market has given this run of this high, and then we're going to go for what? This low. And you can see that happened. I also pointed that the market might also come here next week. So possibly on Monday or Tuesday, we should see price also whip through this as well. All right. So if you doubt me, watch the video of yesterday around the 21st minute to the 24th minute. You see where I was calling this market live, right? So these things are not random; they are precise. All right. So now I've understood this. Now, how do we actually know where to mark? Now, when you're talking about the power of three, there's a time zone you use for your timing. So you're using what? The New York time, right? The New York time. That is the time we use. We don't use Bangladesh time. We don't use Indian time. We don't use Canadian time. We don't use Singapore time. We don't use Japan time. We use New York time. And the New York time currently time zone is what? GMT -4, right? That is the current time zone of New York. And then you can see that you can set it here. You can come to trading view, click on this right corner, and then you set it that was New York. So that's very easy for you. So you set your time towards New York, right? GMT -4 at New York. Just click on it, and then everything will be set. So now, what do you do with this? When you know that the market should do this, right? Now, if you have a bullish market, right? If you are bullish, that means once it hits 12 a.m. New York time, once it hits 12 a.m. New York time, right? This is 12 a.m. now. Once it hits 12 a.m. New York time, you simply put a time marker there. And you put a marker on that time. So this is the market was what? Market was moving. And then we hit New York midnight time, which is 12 a.m. New York time. So now we have our midnight. What do you expect? You want price to do what? If you are bearish, you want price to run up and then give you what? A sell to the downside. Is that simple? So you mark your New York time, the midnight, and then remember the power of three. The market has to go up before it goes down. So if the market is bearish, it has to do what? Run up after New York and then give you what? Maybe a sell confirmation, then what? Drawdown. Don't forget what happened on EU and GBP USD. Don't forget. Don't forget what happened. Don't forget. Look at it. So this is our New York time. Can you see how markets ran above and then during NFP it dropped? So that is what I'm trying to tell you guys. So when you're bearish, this is what you want to see on the lower time frame, right? Then you remember this daily candle now. If you break the daily candle to a lower time frame, this is how it will look like. You're not trading this. This is just a pictorial representation of what I'm talking about. But when you're actually trading it, you're going to go to what the lower time frame, and like this is a 30-minute chart now. It's 30 minutes. So you just do this thing. This thing that you see on the daily candle. This is just what we mean. The market has to run above and then create that wick and then we'll drop down. So the same thing also applies what to the for a bullish scenario. So if the market is bullish now, you mark your midnight time. So the market should do this. Once they hit midnight, once the see price do what? Run down, and then maybe give you what? A bullish break to the upside. So it's just the opposite. The market is bullish. Once the see price, first of all, run downwards, right? Giving you what? This power of 3 setup, and then look for what? A bullish confirmation to do what? To run price to the upside. That is basically all we are talking about. That is basically it, right? That is just what the power of 3 simply means, right? So that is basically it. So if you can understand this particular concept, you're going to really make a lot of money, like a lot of money. All right, let's take a look at what happened on the day before Friday. Let's quickly look at the daily chart as well. All right, this was kind of inside day though. Market was not really okay. It was kind of inside the day. All right, let us see what happened on Friday. Oh, sorry, Thursday. So I'm looking at this candle now. This one before yesterday. Look at Thursday's candle. So based on what I can see, the market was giving a kind of bullish scenario. Why? Because we are rejecting from this other block here. Right? We are playing off this other block. So we hit the high of the other block. So we are playing off this other block here. So that I saw on Friday. So on Thursday, we're playing with other block on Thursday. And they can see how the candles before it were rejected from the other block. So let's see what happened on Thursday. So remember, we are bullish on Thursday. Remember, this is Thursday now, not Friday. Right. Look at Thursday, not Friday. All right, let's look for Thursday midnight candle. So Thursday. That's what you're looking for. All right, where's Thursday? Okay. You can see Thursday here. What do you see on Thursday? Where is midnight for Thursday? All right. All right. So this is midnight candle for Thursday. All right. So you can see the midnight candle for Thursday. You can see how price ran down first. It hits the high of the other block, which we had. I can see how what price did. Price everything was pushing what to the upside before that Friday. So if you maybe bought inside there, maybe I've got some good buys there, and then you'd have bought up until what the high of this point. So you can see how Thursday ran up below first before they was pushing. So Thursday was bullish. So markets ran down and started buying. Maybe we're targeting this higher, this swing, this higher. That would be your TP, right? Now on Friday, price did the reverse, which was what we were bearish on Friday because of what we were resuming the overall move. So on Friday, can see what happened on Friday. This is midnight of Friday, right? So the sell price ran above and then what dropped. So if you are buying on Thursday, I've called this buy, and then on Friday, I've called this sell. So very easy. So this sell was sponsored by pricing what running this liquidity high, running this high, and then what giving us the power of 3 for what is sell. So Thursday was bullish even into Friday, and then Friday was not what bearish. All right. So let's look at another pair. Let's look at US 30. So daily chart US 30 for NFP as well. So can you see the same thing that happened on Friday? Sorry. All right, can you see NFP for Friday? Can you see what market ran above this high? What happened? Drop down. All right, so if you go to a lower time frame, you can see that as well. But first of all, let me explain the higher time frame bias. So on the higher time frame, we took out this liquidity pool here, and then we are dropping down. And then if you take out your two from this swing to that swing, you can see actually what the premium level. Premium level is what, remember, above 50%. So actually above 50%, and that is what the premium level. And if you check very carefully, we are inside an imbalance, right? So inside a fair value gap. So that one I'll teach you guys about fair value gap on Monday. Right, so you had this bearish fair value gap, which price has hit. So if you go to the lower time frame, you can see that we had a power of 3 set up as well. Right, so watch this. So what happened there on Friday? We had this is a midnight candle of Friday. So midnight candle, you can see our price. First of all, It ran down, no problem. And then they gave this buy to the upside for the one. Finally, they dropping down. So Friday was kind of confusing. Number one, we want to see price run above first. So if maybe we're using power of three, markets ran down first. Maybe as markets ran this liquidity here, maybe we have bought inside there, right? Because we are below what the midnight open. So maybe I bought inside there and maybe bought to take out what this high. So as price went above this high, we had what the reverse of what the downside. So maybe I've caused a buy and sell. Remember, you look at the midnight candle, that is the point of reference. You want to see price run below for a buy and then what run above for a sell. So price run below first. We maybe have caused some buy inside there, and then as price took out this high, then it now went what above what this midnight candle, which was sponsored what a sell. So you can see how price when price goes above midnight candle, it sponsors a sell. When it goes below, it sponsors was a buy. That's the power of three for you, right? So that is basically. So I want you guys to back. This information can help you a lot on knowing when to enter the market. Always wait for market to run down when you're bullish and run above when you're bearish. It's very simple. That is what we call the ICT power of three. So when you notice that you not use your higher time frame and then your lower time frame, use your higher time frame to know what the relationship between. Remember that you are not trading power of three blindly. Notice this. You are not trading power of three blindly. You have to wait for what? A confirmation from the lower time frame and also a buyer. So you use your higher time frame to build a bias. I mean, the market is really bullish or bearish. Then use the bias for a higher time frame. That's your higher time frame work. Then the lower time frame was confirmation. So you're using what? Your confirmation entry from what? The lower time frame. So lower time frame, we are talking about the 1 hour chart, the 30-minute chart, the 5-minute chart. Why higher time frame? We talk about the 4 hour, the daily, the weekly. So using the higher time to build your bias. Are you going to go bullish or bearish? It's not just because price went below. Right? It's not just because maybe just saw price going below. Just because price went below, you want to sell. No. Or buy, sorry. You don't just feel like that. That is not how to trade. You have to have a reason. So the market is running down. Why? You look at the high time frame and say, okay, the market is bullish or bearish on the daily or on the 4 hour. You have to use the high time frame to build your bias before doing what? Looking for what? This confirmation with what they run down and above. So this power of day is subject to high time frame direction, right? It's subject to high time frame direction. Very, very important, right? So that is basically where I'm ending today's call. I don't want today's call to be too long. Just make it brief, right? So if you really enjoy this call, let's do what to drop one or two things you learned from this teaching. Tomorrow is going to be a very, very important teaching because tomorrow is going to be psychology, right? It's something that is going to really, really blow your mind. Let me just quickly show you guys what you should expect tomorrow, right? Let me just quickly show you guys what you should expect tomorrow because tomorrow we're talking about if I could meet my younger self, right? So tomorrow is going to be very, very awesome, and I would love to see you guys there. Let me just quickly show you guys the advert from tomorrow. Let me just quickly show you guys the adverts or the flyer for tomorrow. All right, so this I will taking you guys to my Telegram channel in a moment from now. Right, I will show you guys my Telegram channel in a moment from now. So let's quickly check our Telegram channel. So this is my Telegram community. If you're not there, you're missing out a lot. So this is my Telegram community here. You can see tomorrow's teaching will be about psychology. So let's get there. I think this is it. Right. So this is it. If I could meet my younger self, it's more of a psychology teaching. You don't want to miss this for anything. It's a psychology teaching. If I could meet a younger self, I'm talking about the mistakes I made in my 4 years of trading, the things I could have done differently, and the things that I would have focused on. It's just a me talking back to my younger self, my younger trader 4 years ago, what I would have told him to shorten his learning curve, right? The things I would have done differently if I know what I know now, right? So those are the things that you don't need to miss this teaching of tomorrow for anything. No, I just want to invite someone and then share the link of these videos. If you have been blessed by these videos, just want to share links, and I would love to see you guys in tomorrow's teaching. So have a wonderful day, have a wonderful weekend. Cheers and God bless.